Okay, good evening. This is Ken from Tortoise Capital. It's the weekend of May 19th, 2012. The review of the weekend reports. Just jump right into it. I'd first say congratulations to my daughter Jessie, graduating from high school with honors. And hi to my dad, who's down here listening in, watching over number one son's shoulder. So welcome to the senior tortoise of us all. Rachel's soccer team finished the league play yesterday with a victory and a tie, so we're undefeated for the season, and our league champions, as well as winning a couple tournaments. So a pretty good season all the way around. All right, having said that, we'll jump right into the reports. We're looking at a market that is now in bullish, volatile conditions, and I would point out that we're less than 0.1% away from being in sideways volatile, which is only therefore 4% away from bearish volatile. So we've got some rocky road ahead, but technically we are bullish volatile. On an annual basis, using weekly RSI 14, we're at 45 out of 100, so we're now under the median in the low end of normal for long-term trendiness. On the 10-day NDX, we're at 2 out of 100, so we are significantly oversold. Percent stretch above the 200-day moving average, you can see, is right here at 2.01%. And if we lose a 1/100th of a percent, then we are into sideways volatile. Slope of the 50 is negative, and it's coded red, so that's red bear. That's not good. ADX 14 is at 25.4, a strongly trending market, and with minus DI in charge, this is a strong bear beginning to develop here. ATR percentage at 1.37% now puts us into volatile territory, so the market has changed quite a bit in the last month. The current holdings in 26 ETFs portfolio for blended monthly is NASDAQ, financials, and real estate. The excuse me, the 13 ETF portfolio, NASDAQ, U.S. real estate, and U.S. large caps. Next reevaluation scheduled for on or about 1 June. The ETF2 theoretical model exposure is at 0%. The working model portfolio is at 60% exposed. There were 2 sales this week on stops that were hit. So that model, once again, has done a pretty good job identifying weakness in time to act on it. Taking a look at the details of the blended monthly portfolio. Let me pull that up on your screen in a second. Hold on. Okay, looking at the 13 ETF portfolio, we have Treasuries back on top. They're back above 120, and that's the only one of the 13 that's on a buy signal. Everything else is below its 4-month moving average. U.S. real estate, tech, large caps, the Dow, mids, and smalls, so it's everything U.S. still remains at the top. They're just the least weak among the weak. The rest of the globals in poor shape. The downside being led by Latin America and emerging markets. The 26 ETF portfolio tells the same story. The only 2 things out of 26 that are on a buy signal are short-term treasuries and the long-term treasuries. Everything else is weak, and it's being led by the U.S., and laggards are being the emerging markets, Latin America, Brazil, and China. That's been weak all year. So no real change in the global ranking. It's just that the equities are really suffering now. Moving on to tech. All right, what we've got in the health check, the vertical blue lines represent 10, 20, and 30 days worth of look back. The horizontal purple line at 142 represents the swing high that we reached at the end of March. And then 138 looks to me to be another important price target level. After this leg down resolves itself, it looks to me like 136 is the next strong resistance level based on the congestion here in middle of May. The horizontal line at 134 was support, is now probably resistance as well. That was the previous swing low that just got violated this week in a big way. The central black line represents the 30-period regression line, and the outer black lines are the channel that are formed by the maximum excursion from the regression line during the look-back period, which happened Thursday. So that creates the RAF regression channel. The blue line is an Andrews pitchfork, which is really just another way of drawing regression lines or channel lines. And I've used that to extend the RAF regression channel line forward into time so we can see what the expected price channel is going to be going forward. The first 5% rectangle represents a 5% pullback from the previous swing high at 142. So that puts us, that would be the pullback line is right at 135. That was the price boundary that signified the difference between noise and a correction in a bull market. Between 0 and 5% we attribute to market noise. Between 5 and 10% looks like a correction in a bull. Anything greater than 10%, between 10 and 20 we'd classify as a baby bear, 20 to 30 mama bear, 30 to 40, or 30 and beyond really is a papa bear. What we're looking at right now is in the second red rectangle, that would bring a price in at about, let's see, 128, which would be in the middle of, actually resting just above the 200-day moving average. And that would be the boundary between a bullish correction and a baby bear. So we're getting close to that price limit now. But we're still technically in a bullish correction, although it feels pretty horrible. You can see the river is the shaded blue area. The dotted line in the middle is the 30-period moving average, a simple moving average. It's the Bollinger Band mean. And the width of the river is described by or defined by one standard deviation of daily price action, and that's the bound to normal. What's ominous about that is that the river has rolled over and started to flow south. You can see the 10-period moving average is the thick green line. That is rolled over after making it could not get to the back up to 142. It is rolled over. The thin red line is the 50-day moving average. You can see that has rolled over and gone negative, and that's why that's rated as bearish in the market mosaic. You can see price has violated all of those, so that price is worse than the 10, which is worse than the 50, and it's only a couple percent away from the 200-day moving average, which would be formally the end of the bull. We put the sideways market indicator at 2% above that, so we're within a penny of dipping into sideways volatile. You can see the market has been oversold for about 6 days now. It can stay oversold in a bear for a long time in the same way that it can stay overbought in a bull for a long time. So that's not necessarily a sign of being ready to buy, though that will trigger a number of the channeling and overreaction signals as we have seen. The bottom indicator here, the percent price oscillator, acts like a MACD histogram but uses percentages rather than absolute dollars. You can see that went negative on about 6th of May on this second day of sharp selling up here at 138. That's a good early warning signal for a shift in trend. And you can see the jaws of that little dragon have opened and are continuing to point downward, no end in sight. So we have a strengthening bear after a strong bull leg up. And to me, the next target down is the 200-day moving average, a couple percent away. If it breaks through there, then it's Katie bar the door to the south, as intermediate money now would have a reason to start trimming their positions and looking for safety. So we're right in the boundary now of it's bad now and it could get a lot worse pretty quickly. Now on the upside, the first target I'd be looking at is a return back to 135, which is about the middle of that RAF regression channel. And then it would have to get above 136 in my view to be a potential return to the bull. So there's a good almost 5% move to the upside that would be tactically feasible, but wouldn't shift a sentiment back to the bull unless we see a close above 136. So the upside tactically I see capped at 136. 128 is the next target on the downside. I will be rewarding failure in the market, typically by using the VXX or the UVXY volatility ETF. That's been a very lucrative trade for me all week. So the market health check, not looking very healthy right now. This still favors the tactical trader. The market may have been expecting the Facebook IPO to add some juice, but they were barely able to hold steady on that one, and only by having the underwriters doing massive purchasing in the last hour of the day. And so Facebook will add nothing to feelings of optimism, and that's what the market's looking like right now. So not good. Taking a quick look now at the ETF2 database, looking at the top 10 regional indices. They are all on a cash signal, and so that makes the market model, the theoretical model, at 0% invested and 100% cash, so that got just slightly worse than last week, which was 10 and 90. Let me let that finish loading on your screens. The connection in Kansas must be really slow today. Okay, there we go. Sorry about the lag. To repeat, all 10 of the regional indexes are in cash signals. That puts us at 0% invested and 100% cash in a theoretical model, the theoretical asset allocation model. Last week it was 10% and 90%. The SPY at 65 is still better than EFA, the Euro-Asia index, at 51. So it's the U.S. doing better than the world right now. And then among the U.S., it's technology at 68, followed by large caps at 65, mid caps at 61, small caps at 59. So that's techs, large, medium, and small. The two strongest sectors are the Qs and the large caps, and then the two weakest, Latin America and emerging markets. And we saw that reflected in the ETF2 database as well. It's a world market model. Let me let that come up on your screen. There we go. So the U.S. is generally above average, with the exception of weakness now coming into the small caps, the value and the blend. Those have gone under the database median. Everything Asia is well below average except for Malaysia. Japan, Asia less Japan below average. All of Europe below average. Latin American emerging markets especially horrible. And Brazil is horrible, Canada and Mexico lagging. Among the alternate asset classes, corporate bonds and U.S. real estate and treasuries remain strong. Gold started to rebound the last 2 days of the week, along with silver, just in time for you to get a good price on some graduation gifts. Bought some Australian kookaburras and Years of the Dragon for some graduates, and so I got a good price on that. Luckily, better to be lucky than good. Oil has had a significant pullback. Commodities still remain weak, but they're not as bad as they have been. So the one small ray of sunshine. Looking at the U.S. and global business sectors, it is the risk trade. We're back to healthcare, utilities, and consumer staples, as well as the globals. And then the risk on trade is lagging, with materials and energy especially below average. Financials have come out of their leadership position. So this is definitely a flight to quality and mature, stable companies. And we saw that through most of the can last for 6 months at a time as well. I want to quick note the longer-term volatility study on the last page of the weekly. Looking at the last 180 days, you can see we've had a slight uptick now in volatility. It has crossed over its own 10-day moving average twice, and it's had higher lows. And so that looks more like a return to this higher average volatility after a period of exceptional quietude. Still nowhere near the kind of volatility spikes that we saw back in August when it got up well over 1.6%. This is the tail end of August at the start of this chart. So still quite a bit of volatility to go. If this turns out to be the beginning of a big leg down, then that volatility has just begun to enter the market. So let's, even though it feels bad, let's remember it's only down 8% from its swing high and still within bull correction territory. So keep your powder dry. Don't commit to the downside long term. Just be prepared to take advantage of it tactically. Next up, I want to shift to the daily. So let's get that loaded up. Okay, there we go. We'll skip the top bar. We already reviewed that during the weekly. Take a quick look at the gap stat now. The market has gapped down 16 times in the last 30 days. 6 of those 16 times, it has continued to fail for a follow-through average of an additional minus 0.73. 10 times that gap down has resulted in a reverse to close higher with an average follow-through of 0.37%. Gap ups have occurred 14 times. 10 of the 14, or 5 out of 7. The gap up has reversed to close lower with a follow-through of an additional minus 0.6. Only 4 times has that gap up continued to gain for a follow-through of 0.7. So the bigger moves right now are happening on the lower days. The follow-through is still, the follow-through to the downside is still shocking folks and getting bigger moves. And so for me, that's the way to play it. We've got long signals in the overreaction system and the channeling system for the U.S. indexes, basically. You can see that the globals are already below their 200-day moving average, and so they don't qualify for that system. And that's just a reflection of the global trends that we saw before. You can see the 10-day NDX is still oversold, and it can continue to be that way. Market volatility measured by ATR percentage found support it normally will and is now broken up into the beginnings of volatile conditions, and so that can get up to as high as 1. Still be within range of the last 180 days. So we haven't seen ADX gotten stronger, and bad news for the bulls is that the bears are in charge. Quite a large number of channeling and overreaction signals in both the large caps and the ETFs. Well over a dozen high quality 2-to-1 reward to risk ratios using the auto framer technique, where all these are better than 2-to-1. Some are up around 6 and 7. The 10-day max losers have been JP Morgan, Cisco, Bank of America, Caterpillar, and Intel. The ETF losers have been Russia, metals and mining, Brazil, oil and gas exploration, and South Korea. The winners have been the XLPs of the world, Verizon, Procter & Gamble, Walmart, AT&T, and Pfizer, and that reflects the broader trends we see in the U.S. sector spiders as well. So it's the old reliables that are losing the least. That's flight to quality in my view. Next up is the Dow Tactical Summary. You'll see a handful of dojis on there. Hewlett-Packard, Alcoa, Chevron, and AT&T. A whole ton of channeling and overreaction signals. I won't read them all to you. The top 5 max pain range compression signals. Cisco, JP Morgan, Hewlett-Packard, Bank of America, and Alcoa. More than half the Dow test out at better than 2 to 1 on the auto framer technique. And Cisco, JP Morgan looked to me to be very interesting. They have high fraud quality numbers. JP Morgan was a percentage loser, but it tests out at 5 to almost 6 to 1 on the auto framer, so that looks like a pretty favorable symbol. We'll take a look at JP Morgan and Alcoa here in a minute at the end of the dailies. Also, finally, just you'll notice the RSI2 column. Again, more than half of the Dow tests out at below 10 on the RSI2, so they're all favorably poised after 2 days of harsh selling for tactical rebounds using that technique. Next up is the F30, same structure. And what we have here, well, let me let it come up on your screen. We have one doji in Japan. Again, a whole bundle full of channeling and overreaction signals. A 5-day down in Europe. A triple screen in utilities. And then, let's see, 24 out of 30 of the ETFs test out at better than 2 to 1 on the auto framer technique. So that's really take your pick. And that's a reflection of just how sharply the entire broad market has sold off. We'll shift now to the market mosaic. I'll let that come up on your screen. It's horribly slow. Sorry about the delay. Still waiting for that screen to pop up for you. While we're waiting for that screen, I want to check with you. How is the audio coming through? Okay. Okay, there we go with the market mosaic. You can see the slope of the regression line has degraded, and with the last 5 days of selling really starting to accelerate away from the regression line. Zooming in over the last 30, the time series over the last 30 days, it crossed over its own 10-period moving average at a distance of 1 standard deviation away from the mean, and that signals the potential beginning of a major leg downward. You can see, looking at the time series up in the northeast corner, it's already moved over 2 standard deviations from its previous high, and but it can get an awful lot worse just looking at the slopes of the last 6 months. So by no means have we seen the end of potential selling. You can see the percent stretch with respect to the 200-day moving average has pulled all the way back to the boundary of bull, and remember, within the last 6 months it's been 13% below that price level. So all the easy gains, if you will, of the of the bull of the last 6 months have been given back, and we're back to the 6-month average. That thin dotted red line is the 200-period moving average, and so we're very close right now to going underwater. That's not good. I've been doing some work on slopes of the regression lines because I'm interested in that as a technique anyway, and so I don't have the full write-up on this yet, but this is the chart that I'm using to start tracking this, and let me let it pull up on your screen first. Okay, so what I'm tracking now is the slopes of regression lines, and I'm looking at 3 of them in the top frame. This looks back 180 days, and I'm using SPY. As you know, I use the 10-period and the 30-period extensively in my intraday, and that's led me to looking at the market through that lens on a daily basis. And I like the 10 and 30 regression lines on the daily. And so just for a longer term, I decided to add a third one, and that's this thick red line. That's the slope of the 90-day regression line. Now, because the slopes change so little in the longer time frames, the scale is a bit it's hard to compare. So what I've done now is I've gone back through 10 years of data and computed the 10, 30, and 90-day slope of each of those regression lines, and then found the standard deviation, and then created the z-score. So the z-score tells you how many standard deviations above or below the 10-period or the 10-year average the current slopes are. And so what you can see, the blue line is the slope of the 10-period regression line, and as you would expect, volatility gets exaggerated on the shorter time frames, so it has a tremendous amount of variability. Just in the last 30 days, for example, it's oscillated between -1 standard deviation and +1 standard deviation 1, 2, 3, 4, 5 different times in oscillation. So it's not unusual to see the 10-period time frame change quite dramatically, and that's why swing trading is very attractive, because you get sharp moves that last up to 2 weeks and before the truth changes. So that's sort of the argument to be interested in swing trading, and why you have to take your profits when you get them, when you have outsized profits. Now, the black line represents the 30-period regression line, and that's the same line that we saw in the previous chart where I was comparing it to its own 10-day moving average. That's the identical signal line, but this gives us a little more information. Now what you can see is that it has come all the way back right to the -1 standard deviation line that we just saw, and it crossed its own 10-period moving average and is now going south. So there's another leg down that can happen easily. Now what makes this time frame very interesting is when you have both the 10 and the 30-period regression line sitting at -1 standard deviation. What you can say is those two sine waves have just come into phase together, and that can be a turning point for a significant up move. In my view, that's where that it lays the groundwork for that 8 to 10% move that would take us back up through 136 and 142. So that's a kind of a perfect place for it to do that. The last time it's done that those two signals have been in sync like that is way back here almost 4 months ago at the end of December, and then what you saw was an unmitigated bull move that lasted almost 3 months at the start of this year. So the groundwork is laid in because everybody that could be tempted to sell for tactical or short-term reasons has sold, and we could actually see some improvement. That's sort of the case for the 10% upside. If you look down on the chart below, that's the price and then a 50-period moving average. You can see how that's rolling over and now starting to fail. So this is sort of a natural place to see a rebound that would take us back up through the 50 and then up to 142. If we were to see that kind of price movement, these two regression lines would quickly get well, and then they would both be up here around +1 to +2 standard deviations on the upside. So that potential is there, but that's not what the current reading looks like. The longer term regression line, the 90-day regression line, is also down around -1. So this is sort of telling us that everybody is feeling the pain right now, but what it is also telling us is that the pain isn't necessarily over yet just because this little piece hurts. And so I would look at this price down here around this support levels around 120 are certainly well achievable in the short time frame. That's would not be unusual to see it go that low as well. First, it would have to get through the 200-day at 128, and then fail another $8, and then that would erase all of the bullish move of the last 4 or 5 months. So I'm getting very interested now in looking for trade locations in terms of these z-scores of the regression lines. It works intraday tactically. It looks to be pretty interesting for daily charts, and when you eyeball weekly charts, it looks pretty attractive as well. So I will add some write-ups on that, and this is going to become a standard part of the daily because I like to know where we are in the 10-period regression lines oscillations. So moving on. That's sort of a preview of coming attractions. I'm going to kind of blow through these other the typical reference charts. I want to go to the holding XD period stats so we can see where we are here. And what we're going to look at the 10-day holding period as soon as it comes up on your screen. There, almost. When this comes up on your screen, the main thing I want to look at on the 10-day holding periods, there we go. So we're looking at the third chunk, and I want to go to the z-scores. And what we're looking at here is in SPY, the way to read this chart is compared to 10 days ago, the S&P has sold off 4.48%. Now, compared to the last 10 years of data, that places it at minus 1.37 z-score. So it means this is an above average loss over the last 10 days. And if you look at all the indexes, they're all above 1.0 on the downside. EFA is especially hit hard at minus 1.82. It's down 7.3%. That's almost 2 standard deviations of losses within 10 days. And so what that tells me is, while I respect the power of the downside, I believe the easier money has already been made on the downside because it has been such a sharp and abnormally large sell-off in the last 10 days. I'm also cognizant that although the EFA has sold off 7.3%, the worst it's ever done in a 10-day period is 30%. Ouch. That was actually a 7 sigma adverse event on the day that happened. And in fact, you'll see all of these indexes have sold off in excess of 25%, except the Qs, and that's just in the last 10 years. So the selling is, although it feels above average in terms of pain, it's nowhere near the kind of maximum pain that's been experienced just within the last 10 years. So I am cautious about trade location right now, that there could still very easily be a sharp move downward. So if we go up one time frame and look at 20 periods, 20 days, let's look at SPY. The worst 20-day selling period in the S&P was basically 30%. So if we take today as the first 10 days of a 20-day period, it's down 4.5%, but it could lose another 25% in the next 10 days and still be within not quite the worst it's ever been seen. So even though this feels bad, it's nowhere near as bad as it could be, and therefore I really respect the power of the downside. And with volatility just starting to peak up, I'm very alert to tactical opportunities that when the low of yesterday fails, or if we get a new low of the day today in any trading day, I'm really prepared for sudden downdrafts in price and take advantage of that, and then not hold it overnight. We do know that the biggest one-day gains tend to be bounces off the bottoms in bearish markets. And so that's why I don't like holding things overnight on the short side, but I'm fully prepared to take it one day at a time and reward failure in the market. My favorite targets right now are the U.S. small caps, the triple leveraged ETF TZA, and the VIX and UVXY ETFs, which are pure plays on volatility. All three are very, very liquid and very, very tradable intraday using the regression line crossover system, as you've seen me demonstrate a number of times. Okay, so that's enough of those. I want to just take if I can, take a look at just a couple special charts here. Let's see if we can, we'll pull this one up. This is not in your chart pack. So I'm going to go back to that idea of looking at the historical performances of the regression line slopes of the 10 and the 30 period, looking back at the last 180 days. All right, so, no, I'm sorry, this is 2 years. So we're looking back at 2 years worth of data right now, and I've screened out that 90 period just so it's a little easier to see. And if we take a look at the top chart, this is the absolute value of the slope. And so when you don't normalize it using standard deviation, it's very hard to see any signals of interest on the 30 period because it's a lot smoother. But if we go to the bottom of that, the bottom chart actually reflects the Z-score treatment here. And so now you can actually see moves in the 30 a lot easier because we've normalized it. Now, where we are right now, this was as of Thursday, what we saw was the 10 period and the 30 period were hovering right at that -1 standard deviation band in their slopes as compared to 10 years worth of data. The last 4 times that they coincided, 3 of those 4 times responded with really significant, sharp upward moves. So we saw this one, the 2 slopes came together, and then there's a sharp 3 sigma move to the upside. The first one had a sharp 2 sigma move to the upside. Only 1 out of 4 times was there a significant additional sell-off. It turned out to be another 2 sigma to the downside. That's the case for another 8 to 10% sharp sell-off. But the historical norms have favored rebounds off of these kinds of lows, off of recent pain. And so I'm prepared for a sharp move in either direction because we're at this perfect storm where the 10, the 30, and the 90 period regression line slopes are all suffering at the same time. So all of those guys are prepared to buy on dips, in my view. If you look now historically, let's see what those look like in comparison to price. I'm going to let that come up on your screen. What this chart shows is over the last year, we have that 10 and the 30 period regression line slope z-score, and then in periods of red are when the both of the slopes were up around +1 standard deviation, then it started to roll over, and what you got was periods of sharp sell-off in price. That's the lower half. However, at times when both regression line slopes were down around -1 and then started to hook up, you had periods of gains, which I've marked in the yellow. I actually tried putting a green on that, but it obscured some of the colors. So what you can see on that chart, it's hung in the chat room if you want to look at it more closely. There was really only about one time when the regression line slopes rolled over, but price also kept going up, and that was in the middle, the second leg up in this bull right in here. But otherwise, once the regression lines get up above 1 and then start to fail, it's usually been bad for price. And then when the regression line slopes get down around -1 and can't get any worse, it's usually been pretty favorable for the next 20, 30, 40 days. So there's potential in here on a technical basis for a rebound, in the same way that there's potential on a technical basis and psychological basis for another sharp sell-off. So again, I don't have a directional prediction here. I just know that the next moves are going to be larger because volatility has bottomed out and starting to get higher. So this is perfect for an intraday and a short-term swing trader. So take advantage of those kinds of systems. Don't believe in the trades. Bird in the hand is definitely worth 2 in the bush. To take a quick look at what that looks like intraday, we'll go to the next one. And this is just, this was from Friday. There's a case study on Friday. And what we'll be looking at while I'm waiting for this to come up on your screen is I'm just going to use the 3-minute chart. Oh, here it goes. So the label on this one is regression line crossover 2012-05-18. So that's Friday, May 18th, 2012, using the regression line crossover lens, and the symbol is SPY. Looking at 3-minute charts, the river is a 30-period Bollinger Band with ±1 standard deviation. That thick red line is the Bollinger Band mean, or the 30-period moving average. The black line is the 30-period regression line. The blue line is the 10-period regression line. The orange line is the 2-period exponential moving average of price, which I use as a proxy for price, and I've turned off the candlesticks because I find that the lines are a little bit easier to see. So use it. And the final thing is the purple line represents the volume-weighted average price of each of those 3-minute segments, which I'm treating as an indicator of the daily fair value in the minds of the traders, influenced by volume. So what we had on Friday was right around noon Central Time, there was a regression line crossover here at about 130.50. And that's a signal that if you had been short, as you should have been, because there was earlier in the day from the open, there was a gap up and then a harsh sell-off, and it sold off all the way down here to about 130.4, and then price started to get better, and pretty soon it got good enough that the regression line crossover occurred outside of the river, and so the entry for me in SPY was right around 130.55 with a stop below the low of the day at about 130.35, so a 20-cent initial stop. When price and the blue line go into the river, I buy them. My initial target is a return to the Bollinger Band mean. In this case, it blew right through it. My next target is the far side of the river. It came out of the river, couldn't hold, and then started to go back into the river, and now what you see is a regression line crossover outside of the river. The zebras are returning to the river. On the long side trade, what you're able to cash is an entry at 130.60, an exit at 130.95 on a 20-cent initial risk. That's about 1.5 R. If you don't want it, just write a check and send it to me, and I'll take that every day. But now what we have is a regression line crossover outside of the river, and what's nice is that price is reverting back towards the mean, which has been down, and that's been the primary trend of the day and of the week, And so that's a really easy entry to get short at about 130.95 with a stop just above the high of the day, so just call it 131.10. So that's a 15-cent risk, and you play for a return to the mean. It did that. It held and then rolled over. You can, if you exited here, you got a fractional win. But because it never crossed its own 30-period regression line, I sort of like staying with the long-term trend. Now when price and the 10-period regression line resume their downward move, you can buy them again or short them again when they leave the river. And then when the 30-period regression line leaves the river, you officially have the beginning of trending behavior in that direction, so you can really pile on here. And now when it takes out the low of the day at about 130.38, you have a violation of the low of the day in a bearish tending market and downward pressure. Holy smokes. You pile on that thing, and then it goes from 130.40 down to 130, quick, fast, and in a hurry. And so the regression lines give me guidance about which direction to be in during the day and clear and observable measurements about how to go, in which direction. The nice thing is it doesn't allow you to stay wrong very long, and you get in line with price action pretty quickly. Notice that when the market is choppy, the regression lines are inside the river, so there's no need to be in a hurry. Let them leave the river if you're so inclined. And then when all the regression lines are outside the river and they're going in the same direction as the Bollinger Band mean, that's the direction of the day so far. And that's the direction you want to be. And you were better off piling on going in that direction rather than trying to play the counter trends where the initial target is simply back to the Bollinger Band mean. If it does get back to the Bollinger Band mean and then starts to fail, you can get short again right away because it has failed at a place you expected it to fail. You don't have to wait for it to make a new low, and that's what it did earlier on in this move up here. So that's a quick look at the intraday regression line channeling system. I'm doing that technique every single day in both directions using small caps, large caps, the volatility ETFs. I love the technique, and although I've been using candlesticks for 20 years, I feel like the added simplicity of going to the line depiction of price action is actually pretty comforting and makes it a lot easier to detect the signals. Mike asked me, how soon do I get to no lose? Hey, when it gets past half an hour in my favor, I'm never going to lose money on a trade. I just don't care about giving up gains by getting out too early. I hate losing money. So if it goes through half an hour and it's moving with power, I am already moving to no lose, and then I'll just wait to see how much they want to give me. Because to me, it's free money after that point. I absolutely don't worry about, what if you move your stop up too soon and you get, it comes back and scratches you out? Then it's a scratch trade. That's just like rain off a duck's back. I don't even feel that. I don't feel like I'm right or wrong. I'm just trying to see how much free money the market wants to give me. So I get to no lose a lot sooner probably than some books that you would read. But then that suits my psychology, and it's something that I find satisfying. And you got to find your own level of comfort. To me, the psychological issue is much more important than any other issue in there, because these opportunities happen so often, and when they pay off large. I don't need to stick around and second guess, because then if I do get out too soon and then it starts going back in my direction, I just re-enter. I don't care. The cost of re-entry is trivial, and I don't have to sweat the psychology of letting winners get away. I expect to be wrong on every trade. Anytime I take an exit better than -1R, I feel like I'm making money. I've written off the money in the trade as soon as I enter it. And then any exit better than -1R to me is a winning trade. That has really helped my psychology out a lot. Okay, so that's the regression line crossover, looking at it intraday, and you can see some of the new things that we're developing here in Muppet Labs out in Kansas with respect to the slope of those regression lines. What I really like about that 30-period regression line intraday, which represents about 90 minutes worth of data, is when the trend is really working, it acts as a pretty good initial stop here until the price and the regression lines get outside of the channel. Once the black line gets out of the channel, out of the river, I sort of like the idea of the lower Bollinger Band, that little boundary being the trailing stop, and then that will help you stay in the winning trades a little bit longer. But in terms of getting stopped out of it early, it would normally be because I'm trying to front run those moves early on while it's still in the river and I'm getting hints of moving in the direction that I want. And so that's going to be typically the one where I may take a scratch trade early. But really, by the time it gets down to 130.40, I mean, I'm 40 cents into that thing on a 15-cent. That's already a 2R trade at this red line, which is just a retest of the low. So if I would expect it to hold there. Why? Because the last time it was at that price, it held there. And when it held there, it rebounded and would have gone all the way back to where my stop was on normal market noise. So why would I give up any of 2R in hand? That requires me to have an opinion about which way the market's going. So if it gets down here and starts hesitating and then I get out and then it immediately resumes the downward move, I get right back in and I just say, hey, all right, you got the cost of my 2 commissions, so, 10 or 15 bucks. So what? That's sort of, I think you got to have a thick skin when it comes to being right or wrong on individual trades in there. You just got to have that thick skin, that rhino hide just comes from a willingness to not care about being right or wrong or expecting to guess wrong, but protecting against the big adverse moves. This thing pays off enough when it works. I mean, this is at 14.30 on this day. We're showing price here at 130. It went down to 128.50 on the low of the day. There was another 10R move to the downside available that day. And so as long as you're getting pieces of those big outsized moves, the last thing that I worry about is getting to no lose too soon and then scratching a trade. So that's just the way I think about it. Okay, so pending any other questions, we're an hour into this, so I'm going to go ahead and shut her off and get it processed and then upload it to YouTube, and then I will send the link out through email and then post it in the chat room. So, hey, thanks for hanging in with me, guys. Sorry about the shenanigans with getting the reports squared away and sent out. It just had a lot of things going on this weekend, and I'm still playing catch up. So take good care and drive safely.